just going to do some quick introductions and then also just a little bit of administrative items. At the top of your bar, there's a question and answer section that if you open that up, you can ask questions on there, and I'll try to do my best real time. There's also a chat function that if you'd like, go ahead and select that, and I'll also be monitoring those for questions as well. Looks like attendees are still coming in. But I'll go ahead and get started. So good afternoon, good morning, everyone. My name is James Bogart. I am the managing principal of Bogart Wealth. Bogart Wealth is a registered investment advisory firm, so we're fully independent. We are true fiduciaries for our clients. Our clients who are working with us have their assets custodied at Charles Schwab. Bogart Wealth's core competencies are financial planning, tax optimization, and investment management. We have, if I can get the tabs working. We have 3 offices, one up in McLean, Virginia, one in Houston, Texas, and then also one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. I always emphasize your kids and your parents are some of the largest variables to anyone's financial plans. We've made it part of our firm's culture to give your children access to certified financial planners. You know, I frequently will say, what would you do differently now that you know what you know, but when you were in your 20s? And a lot of times what we're doing is helping kids with, you know, how to set up their 401ks, how to invest the 401ks, where should they invest, things like that. We're happy to be a resource for them as all part of our service offering. Part of the why of Bogart Wealth is to spend a tremendous amount of time educating. And for anybody who doesn't know, we typically do live events in the Houston and Woodlands market. We also do live events up in Virginia. We call it all part of our retirement cash flow optimization plan. But we do one on the retirement planning timeline, one on retirement income planning, one on Social Security planning and Social Security strategies, one on tax optimization and tax optimization strategies, one on estate planning strategies, one on net unrealized appreciation and post-retirement income strategies, one on long-term care, one on long-term care insurance, and then last but certainly not least is Roths versus traditional 401ks and IRAs. We've added a whole series of these webinars. Obviously, we're not doing live events for probably at least the next month, if I had to guess. But in the meantime, I've decided to do some weekly webinar series. We will send out the slides and we'll also be recording this if you'd like to get a recording to watch it later or send to any of your friends. If there's a topic you'd like to hear, please feel free to annotate it. I did one last week on can you still afford to retire? The biggest negative feedback I got was that it was too long, and so what I've decided to do in the short term is break down the sections so that people can digest them a little bit more in more detail. And so that's really what today's is, which I'm going to spend a lot of time talking about how the interest rate's going to affect your retirement. And a lot of this is translating into specifically the pension benefit programs that ExxonMobil has. So, you know, by way of background, in 2006, the Pension Protection Act was established, which essentially defined the rule calculation associated with any company that was offering a lump sum option within their pension program. It defined the discount rates that are going to be used. It also defined the actuarial table that's going to be used. It clarified that non-spousal beneficiaries can do rollovers. It also clarified that after-tax balances in 401k plans can go to Roth IRAs. It also established that company matches can be diversified. A lot of you might remember prior to 2006, in order to get the extra 1% on the ExxonMobil company benefit match, you had to have it go to stock. After 2006, they clarified that you were allowed to have that in the other diversified options. It also defined IRA and 401k contribution limits and going forward. Today, I'm going to spend the vast majority of the time talking about the first 3, which is essentially the rules associated with the ExxonMobil discount rate for the pension programs. Now, because of the rule change in 2006, ExxonMobil effectively has 2 categories of households. Those that are considered grandfathered and essentially everybody else. So in order to be grandfathered, you had to be over 50 at the end of 2007 and had more than 10 years of service before January 1st, 2008. And essentially for this category of individuals, there was no change to the rules. To kind of translate a little bit more simply, you had to be 55 and had 15 years of service before December 31, 2012, or born before 1958 and hired before 1998. Now, for this age group, you use the 95% of the 30-year Treasury bonds, and it's rounded up or down to 0.25%. For this age group, we also use the ExxonMobil 2000 mortality table. Now, truthfully, this group is very easy to calculate what the discount rates are going to be for them. And as we've seen, the 30-year Treasury bond has had a significant period of time of more of a downward trend. And that has also continued over the last couple of weeks. It did go down pretty exponentially 3 weeks ago, then it popped right back up. It is still down from where it was going into the quarter. But for this age group, we do know that first and second quarter were at 2.25%. As of yesterday's close, we are now confirming that it's going to be 1.75%. And we're going to see April through June 30th are going to determine what the fourth quarter rates are. Right now, the 30-year Treasury rates are hovering around 1.3. So if I had to guess, there's a chance in the fourth quarter we could see them go down. I wouldn't necessarily say hold off. We'll talk about timing of when we should request packages and looking at your scenario. But it is something to be mindful of, is that there is a chance that the discount rate for the grandfather category will go down in the fourth quarter. All right, transition over. Let's talk about everybody else. And so this was anyone who was under 30 by December 31, 2007, and now these new Pension Protection Act rules apply. For this age group, we use three segments that are based off of high quality corporate bond yields. And corporate bond yields have been higher historically, have been significantly higher than Treasury rates, and higher yields are bad. Now, these rates are officially published every single month by the IRS on the website. I included the link here on the slides. Also, for this age group, we use the IRS mortality tables, which are released by the IRS every single year. Now, obviously, longer life is good. Now, compared to the grandfather category versus everybody else, if you remember with the grandfather category, I said that the mortality table was set by ExxonMobil in the year 2000. It has not been updated in 20 years. So some of the difference between the grandfather and the all other category has been made up for by the fact that the IRS mortality table has been updating every single year. It's about a 4-year mortality difference now over the last 20 years. Now, we obviously saw this first affecting pension plan participants in 2013. So if you were born after 1957 or hired after 1997, this is going to be the category that we use to determine your pension calculation. Now, we have seen a tremendous amount of movement with regards to these corporate bond rates. And this is kind of a scaled out version of what the interest rates have done. The green is segment 1, the blue is segment 2, and the orangish red color is segment 3. And I'll talk about these in a little bit more detail. I have an example coming up. But what we have seen recently is a significant spike in rates in the month of March. And a lot of that is due to what's going on with some of the market uncertainty and turmoil. And we've really seen rates move now. So here's kind of a zoom in on this, looking back from January 2019 up to March of 2020. And we're seeing what's happening with these rates and what we're projecting the rates to be. And to kind of illustrate this story, you can see essentially, this is just looking at the month of March and what's happened. But we started early on in March, we saw the rates trending continue to happen. March 6th was where we saw the absolute low, and then they started rising. March 20th is where they peaked out, well, specifically the segment 2 and segment 3 peaked out, and then they started falling again. But what's happening is the average, because for this age group, we only look at the 2 months of the preceding quarter that determines the following quarter. So February and March are determining the third quarter rates. So even though February was very, very low and the beginning of March was very, very low, the end of March skyrocketed. I mean, we look at this rise. We went from 1.44 up to 4.71 at its high We went from 2.51 up to 4.79. We went from 3.07 to 4.96. Now, all of these are from the month of March are used, or we're determining them based off of projections. It's a tool that Pete Canora in my office has built. It's fantastic. It's been very, very accurate for the last several years. Now, I will say that based upon the amount of volume that we've seen recently, I wouldn't be surprised if there's just a little bit of disparity between our numbers and the official numbers. We will see the official numbers getting published probably the second week of April, and that's when we'll also see the ExxonMobil benefit sites updating. But based on this, and I hate to be the bearer of bad news, but for the all other category, we're now actually modeling that the third quarter rate is going to be higher than the second quarter rate. Now, for a lot of you might have seen that we were actually projecting at one point that the all other category was actually going to go down by about 36 basis points. And in a matter of 2-week period of time, it completely reverted, and now we're at the point where it's actually going to be higher than what it is in the second quarter. I've had a lot of people asking me, should I change my retirement date and now go in the second quarter, having a June 1st benefit commencement date? The answer really is ultimately it's going to be very difficult to pivot to get your packages now in time, and obviously it wouldn't even be able to be submitted in time to get the check. But the answer is yes, you could still get the June 1st rates. But for those of you that are still working and still on the payroll, we actually think that a 0.05 increase pales in comparison to the additional 2-3 months of income that you're going to see. And if you're under the age of 60, ExxonMobil still applies a discount on your lump sum program if you're under the age of 60. So continuing to work will reduce that discount, offsetting this 0.05. So in most instances, I am actually telling folks, still keep with the plan, September 1 or August 1, whichever it was for your situation. Don't necessarily feel that we need to knee-jerk or rush to get to retire earlier. Now, what I will say is projecting the fourth quarter rates is beyond premature. But if I will say, just kind of going back here to this slide, if rates even stay anywhere in this range as to where they've been as of the end of March, then if I had to guess, we're going to see an increase in the fourth quarter rate. Now, for the all other category, I made the comment earlier, it's the last 2 months of the quarter are going to determine what the fourth quarter rate is. So the month of April has essentially no implications whatsoever on what the fourth quarter rate is going to be. It's only going to be May and June that will determine the fourth quarter rate. And so we will start doing projections for the fourth quarter. It will give us an indication of the direction of the rates. But if they do stay in this realm, we could see a significant increase in the fourth quarter rates to the tune of 1% or more. And I'll talk about sensitivities in a minute in terms of what interest rates do to someone's pension lump sum benefit. Now, here's a quick example of determining the lump sum from the annuity, and it's relatively crude in the sense of how we determine it, but what we did was we used the first quarter 2020 rates for somebody who's retiring at the age of 60. Now, we know the first quarter rates. They are official rates. So segment 1 was 2.11, segment 2 is 3.04, segment 3 is 3.67. The annuity for this individual was $4,977.73 per month, translated to $59,733 per year. Now, remember, we take the annuity, there's no cost of living adjustment. So that payment stays flat for the rest of your life. And the life expectancy, and again, this is a all other category household. The life expectancy now is age 84, which means they're going to receive or projected to receive annuity payments through their 83rd year. And this is, again, it's a very simplistic version, but what it's doing is showing you how they calculate the lump sum factor. And so the way that these segments apply, again, if some person is retiring at the age of 60, they then will determine that if you took a lump of cash, you needed to then translate that into an investment strategy. And so the first 5 years are what we use to apply segment 1. So again, I mentioned segment 1 is 2.11. So here's the first 5 years showing 2.11 being applied. And then there's a discount factor associated based upon your age that goes all the way up to your mortality table. The next 15 years are where we have segment 2 applied. And remember I said it was 3.04 for the first quarter? Well, that's what's showing here, and that goes all the way through the household's 79th birthday. And then the remaining 4 years have the 3.63. Now, this is then, once we apply the discount factor, and we can see what the probability of payments are, and we can then calculate the present value, which is what ultimately gives us the present value to calculate the lump sum number. And again, we're rounding this to kind of give you an illustration of how the math is calculated. But higher interest rates means it's a larger discount, so that lump sum value is going to go down. And I already mentioned how we apply the 3 segments, but the point really ultimately is if rates come down, the lump sum goes up. If rates go up, the lump sum goes down. And here's just kind of some sensitivities or examples to kind of show you this. And again, same illustration using the first quarter interest rates, lump sum value of $1 million. But there's a general rule of thumb. If we see rates go up by 1%, then we're going to see about a 10% change to the lump sum. It's not quite completely linear, but for example, here's just an illustration of the increase of the 1%. So as rates went up by 1%, this example was impacted by 9.4%. So the $1 million lump sum went down to $905,665. 2% increase took it all the way down to $823,813. Now the same goes the other way, right? If they decrease the rates, then the lump sum goes up, and that's a lot of what we've been seeing. So rates went down, and even for the last 12 months, we've seen almost a 1% decrease. So we've seen about a 10% rise in these lump sum values. And we do believe that rates are going to continue to be volatile. I have a hard time believing that corporate bond rates are going to get back to where they were January and February that brought the rates so low. But anything's possible in this market environment. And I do think as sentiment continues to be more concerned associated with coronavirus, ultimately there's not going to be a massive flow back into corporate bonds in the near term. And there is a decent chance that we're going to see rates actually increasing on the corporate bond side. The question ultimately will be how much are they going to increase and what implication does that have for your household? We also get asked the question of when should you consider delaying taking the pension? So why not retire and then delay taking the pension? Well, excuse me, when I say the pension, I mean the lump sum. First and foremost, if you do not need the money right away and you're retiring before the age of 60 and you're taking the lump sum and expect interest rates to fall, then we should leave it there. Let's get the discount that's being associated with it reduced and automatically get the guaranteed 5% per year that ExxonMobil is discounting your pension lump sum benefits by leaving it there. However, if you're under the age of 60, that might make sense. But if we start to see interest rate risk, then we might want to really consider taking advantage of taking the lump sum earlier because of that interest rate risk. And going back here, for example, if rates go up by 50 basis points in a year, that's a 5% decrease. That's completely offset the benefit of, well, almost completely offset the benefit of delaying it to get back some of that early retirement discount that ExxonMobil imposes. And if they go up more than that, then that's actually going to hurt you. And it might take a couple years to actually get the rates back, to get the benefit back from that reduction before we make sense. So one thing I would say is the decision on lump sum versus annuity is extremely personal. We honestly believe that the lump sum is a hedge against inflation risk. The annuity is a hedge against insurance longevity risk. So if you outlive the mortality table, it obviously will make more sense to consider that apart, but ultimately comes down to someone's risk profile. And I would say every household is going to be very, very different. Now, if you are fortunate enough to have a supplemental pension plan or additional payments plan, those two categories of the pension program are only eligible to get lump sum options. So no matter what, you're going to have interest rate risk on those portions of your benefits. And if you can still take the pension off of the qualified portion, but the supplemental pension and the additional payments plan would fall into that category of absolutely taking on interest rate risk. And we need to be mindful of what interest rates are doing in terms of the timing of your retirement. All right, I haven't any questions, I'm kind of surprised. What we did here was just showed a basic retirement roadmap. And this is for somebody that would have a September 1st benefit commencement date. Part of our planning process is helping you determine the dates and what makes sense for your situation. And so really what we were trying to illustrate here was if someone had a September 1st benefit commencement date, this is what the timeline approximately would look like. Now, with the September 1st benefit commencement date, the earliest you can request your package is 120 days out, which would be May 1st. So at some point after May 1st, usually it's in the months of May and June, we want to inform benefits and request the intent to retire package. And at some point in there, you're going to inform your supervisor of those dates in writing, which is ultimately what gets the ball rolling for executing your retirement benefits. Typically, end of May, early June, we will receive the intent to retire package. And that's where any advisor that you're working with should sit down and complete that package with you. For anyone that's married, you're going to have two places that the employee is going to need to sign and notarize, one that the spouse is going to need to sign and notarize. If you have a supplemental pension or an additional payments plan, there's additional documents that need to get signed and notarized. But that's where these are irreversible decisions, and we're making the decision of taking lump sum versus annuity. We really, really recommend have an advisor who's comfortable with the packages, sitting there helping you walk through that chapter. Now, in order to get your package returned on time, you get your check delivered to you on time, we need to have the package returned by July 24th at the latest, because they want 35 days prior to the benefit commencement date in order to be able to process everything correctly. Now, late August, early September, you're going to get the checks. So obviously with the September 1st benefit commencement date, we typically see that they come a couple days before the first of the month. You also, and the lump sum check, the qualified portion, which is usually the biggest, is in a check. That's the only way they will send it. It'll be made payable to whatever custodian you choose to work with for your benefit. So it'll say specifically, if you're working with us, it'll say Charles Schwab for the benefit of John Smith. And then it'll obviously be delivered to you in the form of a white envelope. So be on the lookout for it. Supplemental pension check and additional payments plan, we'll have those usually set up to go right into the checking account on file. Same if you have a supplemental savings plan, that will go to that on file. Now, we always want you to have, deliver that check in. Let's get it deposited into the account so it's not just floating out there as a check. That's also a great time to finalize whatever plans from an investment perspective that you're ultimately going to be commencing. Now, after you're officially retired, so after September 1st, is when you can actually be eligible to now roll over the savings plan. That does not mean you're required to by any means, but that's the earliest you're possibly able to do it. And everyone's situation is going to make it's going to be different in terms of timing of rolling over the savings plan. You're by no means forced to take it right when you retire. You can leave it there theoretically as long as you want. We typically recommend, if you've got big tax paid, we might want to look at doing it sooner because we can move the tax paid to the Roth. If you have NUA, that might make sense as well. But be very careful taking any money out of the savings plan if you're having any intention of taking advantage of net unrealized appreciation. Now, once you do that, we'll be on the call with you. We will actually walk you through all of the modeling of your scenario, of what makes the most sense. And at that point in time, we'll get on the call, we'll call benefits. At some point, it takes about 7 to 10 days for those checks portions to come in. It's about 14 days for all the stock portions to come in. And then once they're in, we want to make sure that we revisit on whatever the strategy is associated with what stock we're going to keep. We want to make sure your cost basis gets updated in there, so that's all done. This next slide here is just honestly going through a little bit more detail of what I was just describing. But the key dates for a September 1st benefit commencement date, oh, I found a typo. So that would be a September 1 benefit commencement date, but it means that your first day of retirement would be August 31st. Last day of the payroll will be August 30th. And the earliest you can commence the package, as I mentioned, was early May. We do want to get that back, like I said, July 24th. That's the most critical date there. And then once that's in, that starts the ball rolling on retirement and retirement cash flows. So in terms of strategies, things to be looking at now, you know, if you're even considering retirement for the third quarter, you absolutely need to have a plan. Understand your budget, your cash flow needs, and any anticipated future cash flow expenses. Also understand your risk profile, because I will say that this market environment is, in my opinion, changing some people's risk profile. And that probably is a good thing, because honestly, for the last 11 years, the markets for the most part have just gone straight up, and people haven't had that awareness that, hey, you know, recessions are real and this happens. You know, if your goals for time horizon have not changed, your overall investment strategy should not change. You your risk profile should always incorporate your short and long-term goals. So if you're imminently retiring and we need to have cash flow generated from the portfolio, we want to make sure that we've incorporated that in whatever investment strategy that we're deploying. And making investment decisions out of fear and greed is without a doubt not a long-term investment strategy by any means. And so, we're more than happy to be a resource. One of the calls to action from any time that we do these presentations is for absolutely no cost, absolutely no obligation. We do offer to do a complimentary financial plan for any ExxonMobil household. That's part of who we are and part of what we do. And we'll be incorporating all of the different elements along the way. In terms of upcoming events, I'm actually about to announce I'm going to be doing one on Friday, April 3rd, on the CARES Act, new rules, planning, strategies, and opportunities. I'll be doing that at 12:30 Eastern, 11:30 Central Time. Again, I'll also be recording it and send out the slides if you can't attend. Then on April 8th, I'm going to do one on why should you consider Roth conversions now, whether you're an active employee or already retired. That's a great talk, parceling off a segment of what I did on the last one. And then on April 15th, I'm planning to do on how to generate income in a recessionary environment. I've had some people send me some suggestions of additional topics, and I'm more than delighted to build a talk if I need to. That's what I've been doing for all of these, to make sure that we're answering any questions that folks are having. But beyond that, that is all that I have for today. Highly encourage, if you haven't done a plan yet, let's absolutely sit down, run the numbers, do a plan, make sure that we're still in line, especially if you're even considering a third quarter retirement. We do grow 100% by referral, so please feel free, don't keep us a secret. If you've got your friends who are asking about some retirement questions, we're delighted to be a resource, and anyone who's working with us will attest that we are not high-pitched sales guys. We're here to help educate and make some good decisions. And here's our contact information. So feel free, reach out to me, Pete Knorr, Grant Stuckey. Mindy's going to follow up and follow up for any of the attendees, see if you had any questions, if I missed anything. One other thing I didn't mention yet is every week we send out updates on the discount rates. If you're not on those lists, please let us know. Send me an email. We'll make sure you get on the list. Even if it's just us sending an email, we're not soliciting or anything like that. You just want the information. Happy to send it to you. That's all I had for today. I wanted to keep it kind of short and sweet. I actually didn't have a single question come in, so I guess maybe I was clear enough, or people just didn't want to ask questions. But we're always delighted to be a resource. Feel free to reach out. Thank you very much, and have a fantastic rest of the week. Take care.